You have probably heard your whole working life that touching your 401k before age 59 and a half is financial suicide. The 10% penalty, the income tax, the lost compounding, every book, every podcast, every HR brochure on the day you started at your first real job, all of it telling you the same thing: do not touch it. And for most of your career, that advice served you well. But there is an exception built directly into the Internal Revenue Code, Section 72T, that changes the math completely if you retire early. It is not a loophole. It is not aggressive. It is not a workaround. It is a published IRS-sanctioned path to withdraw from your retirement accounts starting in your 50s without owing a single dollar of penalty. The shocking thing is not that it exists. The shocking thing is how few retirees know about it, how few financial advisors mention it, and how easy it is to execute when you understand the mechanics. Before I walk you through it, this video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. The strategy I'm about to describe is complex enough that the IRS has spent decades issuing revenue rulings and notices clarifying it. Getting it wrong retroactively can trigger every penalty you are trying to avoid, plus interest. Do not attempt it without a tax professional who has done it before. The rule lives in Internal Revenue Code, Section 72T2A-IV, which allows distributions taken as a series of substantially equal periodic payments to escape the 10% early withdrawal penalty. The IRS calls these SEPP distributions, and they are often referred to in financial planning circles as 72T payments. The basic requirement is simple to state and painful to violate. You commit to a calculated annual withdrawal, the same amount each year, or using a permitted calculation method, and you keep that pattern going for the longer of 5 years, or until you reach age 59 and a half. Break the pattern early, take $1 more or $1 less than calculated, add a contribution to the account, change the calculation method without IRS permission, and the entire plan collapses retroactively. Every penalty you avoided gets clawed back, plus interest. Picture Arthur, a retired electrical engineer from Bloomington, Minnesota. Arthur stepped away from his employer at 53 with $840,000 in his 401k and another $200,000 in a rollover IRA from a prior job. Arthur did the math. He needed roughly $38,000 per year to cover his expenses until Social Security kicked in at 62. He had non-retirement savings to cover part of that, but not all. He needed about $24,000 per year from retirement accounts, and he needed it starting at 53. A straight distribution would cost him the 10% penalty, which at $24,000 is $2,400 per year, plus ordinary income tax. Over 6.5 years, that penalty alone would total roughly $15,600. Arthur set up a 72T plan, correctly calculated, and his penalty bill dropped to zero. How the calculation works: the IRS publishes 3 approved methods in Revenue Ruling 2002-62, as updated by Notice 2022-6. Method 1 is the required minimum distribution method, which divides the account balance each year by your life expectancy factor from the IRS tables. This method produces the smallest initial payment, but resets each year based on account value. Method 2 is the amortization method, which treats the account like a fixed loan amortized over your life expectancy at a chosen interest rate. This produces a fixed annual payment that does not change. Method 3 is the annuitization method, which uses an annuity factor from published tables. Most retirees use the amortization method because the payment stays flat and predictable. The interest rate you can use is critical. Under Notice 2022-6, you may use any rate up to 120% of the federal midterm applicable federal rate for either of the 2 months before the distributions begin, with a minimum rate of 5% if the 120% calculation comes out lower. In recent years, that has produced interest rates around 5 to 6%, which meaningfully increases the allowed annual distribution compared to the much lower rates retirees were forced to use from 2010 to 2021. Let us do the math for Arthur. His combined IRA balance for the 72T plan was $500,000 because he chose to set up the plan on a portion of his retirement accounts rather than all of them. Using the amortization method at a 5.5% interest rate and a single life expectancy of 31.4 years at age 53, his annual distribution calculates to roughly $32,000. That is more than Arthur actually needed. So Arthur did something many retirees do not realize is permitted. He split his IRA into 2 separate IRAs before starting the plan. He set up a 72T on one IRA holding $200 and $50,000, producing a distribution of about $16,000 per year, which, combined with another modest withdrawal from a non-retirement account, got him to the $24,000 he needed. The second IRA, untouched, continued to grow unrestricted. If Arthur ever needed more money in an emergency, he could tap the second IRA with only the 10% penalty on that specific withdrawal without blowing up his 72T plan. This is the single most important tactical insight in the whole strategy. The 72T plan applies only to the specific account you designate. You're not locking up your entire retirement future. You are locking up one carefully sized sleeve of it. If you do the math wrong and set up the plan on too large a balance, you are forced to take more each year than you need. If you size it too small, you cannot cover your expenses. The art is in the sizing, which is why splitting accounts before starting is almost always the right move. Trap number 1 is the contribution rule. Once you start a 72T plan on a specific IRA, you cannot contribute to it, not even a rollover from another account. Any addition is treated as a modification and kills the plan. If you are still working part-time after starting the plan and you want to contribute to a retirement account, do it somewhere else, a separate IRA or Roth IRA that is not part of the 72T. Trap number 2 is the timing of the first distribution. The plan year starts with your first distribution. If you start on June 1st, your plan year runs June to June, not calendar year. This matters because if you also want to take your full annual distribution, in the first calendar year, you may need to either take a prorated amount or make sure the timing aligns with how you file taxes. Most retirees use a calendar year plan, where the first distribution is taken in January and each subsequent year follows the same month. That keeps 1099-R reporting clean. Trap number 3 is the account value volatility problem with the RMD method. If you use the required minimum distribution method, the payment recalculates each year based on year-end account value. In a market downturn, your next year's payment shrinks. This can create cash flow problems. Notice 2022-6 permits a one-time switch from the amortization or annuitization method to the RMD method if account values drop, and you need to reduce the payment to avoid depleting the account. This is the only permitted mid-plan change, and it must be executed precisely according to IRS guidance. Trap number 4 is the rollover interaction. You generally cannot add funds to the account through rollover once the plan has started. If you have an old 401k at a former employer and you want to roll it into the IRA running the 72T, do that rollover before the plan begins, not after. Post-plan rollovers are treated as modifications. Trap number 5 is the reporting mistake. Every 72T distribution generates a Form 1099-R from the custodian. The custodian typically reports the distribution with Code 1, meaning early distribution with no known exception, even though your plan qualifies for the Section 72T2 exception. This is because the custodian has no way to verify your plan is correctly calculated. You must file Form 5329 with your tax return every year to claim the exception. Use exception number 02 on the form. Skip this step, and the IRS computer flags the distribution as penalty subject, generates a bill months later, and you have to respond with documentation of your plan. Keep a written 72T plan document in your files, signed and dated, showing the calculation method, the interest rate used, the life expectancy table reference, the starting account value, and the expected annual distribution for the full plan duration. There are other exceptions to the 10% penalty beyond 72T, and some are far simpler. These matter because 72T is heavy machinery. If a simpler exception fits your situation, use it instead. The IRS maintains the full list in the instructions to Form 5329 and in Publication 590B. The rule of 55 is the most commonly missed. If you separate from your employer during or after the year you turn 55 and you have a 401k with that employer, you can take distributions from that specific 401k without the 10% penalty. Not an IRA, not a 401k from a prior employer, only the 401k from the employer you just left during or after age 55. For public safety workers, including qualified firefighters, police officers, and certain government employees, the age drops to 50. Joyce, a retired police sergeant from Pittsburgh, Pennsylvania, left her department at 52. Because of the public safety exception, she could begin drawing from her governmental 457B plan or her 401A plan without penalty immediately, without needing a 72T plan at all. Check the plan type before concluding which exception applies. A massive, often overlooked mistake is rolling the 401k into an IRA before applying the rule of 55. Once the money leaves the 401k, the rule of 55 is lost for those funds. If you are between 55 and 59 and a half and might need early access, leave the money in the 401k until you no longer need the flexibility. Rollovers are forever. Think twice before executing one in your late 50s. Medical expense exception. Distributions used to pay unreimbursed medical expenses exceeding 7.5% of your adjusted gross income are exempt from the 10% penalty. Report on Form 5329 using exception number 05. For a retiree with $40,000 of AGI, the threshold is $3,000. Any medical expenses above that, including long-term care, insurance premiums, if self-employed, and other qualifying costs, can be paid from retirement accounts penalty-free. Health insurance premiums for the unemployed. If you received unemployment compensation for 12 consecutive weeks and you use IRA distributions to pay health insurance premiums for yourself, your spouse, and dependents, those distributions avoid the 10% penalty. Only applies to IRAs, not 401ks. Useful for retirees who leave jobs involuntarily and need to bridge to Medicare. Higher education expenses. Distributions used to pay qualified higher education expenses for yourself, your spouse, your children, or your grandchildren avoid the penalty. This applies only to IRAs. If you are paying for a grandchild's college in your late 50s, this exception can cover tuition, fees, books, and room and board up to the school's published cost of attendance. First-time home purchase. Up to $10,000 lifetime, withdrawn from an IRA for a first-time home purchase, avoids the penalty. The home has to be for you, your spouse, your child, your grandchild, or your parent. First time means you have not owned a principal residence in the prior 2 years. Disability. If you become totally and permanently disabled, distributions avoid the penalty with proper documentation. The bar for disability under IRS rules is high, generally matching Social Security disability standards. Birth or adoption. Under Secure 2.0, up to $5,000 per parent per child can be withdrawn from a retirement account within 1 year of birth or adoption without penalty. Relevant for grandparents helping adult children, though the exception technically applies to the parent, not the grandparent. Terminal illness. Secure 2.0 also added a terminal illness exception. If a physician certifies you have a condition reasonably expected to result in death within 7 years, retirement account distributions are penalty-free. Federally declared disaster. Secure 2.0 permits up to $22,000 per qualified disaster withdrawn from a retirement account without penalty, with tax spreadable over 3 years if elected, and with the option to recontribute the funds within 3 years as a rollover. Now consider Helen, a retired accountant from Tallahassee, Florida, who retired at 56. Her situation required about $30,000 a year from retirement accounts until she could claim Social Security. She had a 401k at her most recent employer worth $400,000, plus an old IRA from a prior job with $200,000. Helen initially planned a 72T on the IRA. Her advisor, who actually knew the rules, walked her through the rule of 55 first. By leaving the 401k at her last employer and taking distributions directly from that plan, she could pull whatever amount she needed each year with no rigid schedule, no 5-year commitment, no penalty, until age 59 and a half. After 59 and a half, she could roll the remaining balance to an IRA and enjoy full flexibility. But the 72T plan was unnecessary. Helen saved years of paperwork and retained total flexibility. The lesson is that 72T is the tool of last resort. It is powerful and works when other exceptions do not fit. But for retirees between 55 and 59 and a half with a 401k at their most recent employer, the rule of 55 is almost always the better path. For retirees under 55, 72T becomes the primary option if early access is truly needed. Tax withholding on 72T distributions requires careful handling. By default, IRAs withhold 10%, federal and employer plans withhold 20%. You can adjust both using Form W4P for periodic retirement distributions. If you elect to withhold more, the withheld amount is treated as a distribution for purposes of the 72T calculation, which is the part that trips up retirees. The gross distribution before withholding must match your calculated annual payment exactly. So if your plan calls for $32,000 and you want 20% withheld, the custodian should distribute $32,000 gross, withhold $6,400, and send you $25,600. The full $32,000 counts as your 72T payment. Consider your state tax too. Most states follow federal penalty rules, meaning if the federal 10% penalty is waived by exception, the state level penalty follows. California is the main outlier, with its own 2.5% additional tax on early distributions. Other states may have quirks worth verifying before starting a plan. One more strategic layer: Roth conversion ladders. This is a technique popularized by early retirees that works alongside or instead of 72T. The idea is to convert portions of your traditional IRA to a Roth IRA every year during low-income years after retiring early. Each converted amount becomes available for withdrawal without penalty 5 years after the conversion, under the 5-year rule for converted funds. So if you convert $40,000 to Roth at age 54, that $40,000 becomes available at age 59 without penalty. Stack these conversions annually starting at retirement, and by the time you need the money, there is always a 5-year age tranche of converted principal ready to tap. This works beautifully for retirees who can cover their expenses for the first 5 years from taxable savings, while the Roth latter seasons. There is a critical interaction to watch. Conversions fill the taxable income bucket, so the tax cost of converting during the 72T period adds to the ordinary tax on the 72T distribution itself. Running both simultaneously requires projection work to avoid pushing into higher brackets. Most retirees pick one approach as primary, with the other as a secondary boost in years where income dips. Early retirement is not what it used to be. A decade ago, the interest rate environment made 72T plans produce tiny payments, barely enough to buy groceries. Today, with Notice 2022-6 permitting 5% minimum interest rates, the calculated payments are dramatically larger, making the strategy genuinely useful again for retirees in their early 50s. If you have not updated your early retirement plan since 2022, the numbers may have shifted meaningfully in your favor. The truth no one says out loud is that the 10% penalty was never a ceiling. It was a deterrent. For most working-age people, that deterrent is helpful. It keeps them from raiding retirement savings for cars and vacations. But for the genuine early retiree, the person who has saved aggressively, who is stepping away from a career in their 50s with real money in their 401k, the penalty is simply a toll that you can legally and completely avoid if you understand the exceptions. You do not need to wait until 60. You never did. Subscribe so you see the rest of this retirement series, because the next video covers the exact order to spend down accounts in early retirement, from taxable to tax-deferred to tax-free, in a way that minimizes lifetime tax and stretches every dollar you saved. Leave a comment letting me know your age and whether early retirement before 60 is something you're actively planning, because I'm putting together a separate breakdown for the 50 to 55 age band, and I want to make sure I cover the questions you actually care about.